Hey everybody, Brett Rice, coreVISION Financial Group, coming to you today with another video in our series on financial topics. Please go to our YouTube page and subscribe so you're notified when we post a new video. Today we're going to be joined by Jason Pike, partner here at coreVISION, and we're going to be talking about the recent Fed interest rate cuts and how that affects you and your personal finances. So Jason, thanks for joining us today.
Absolutely. Thanks for having me, Brett. It's great to be back in here. Well, I think you did a great job. I appreciate that. I'm a partner here at coreVISION Financial Group. This is year 20 for me, so kind of feel old. That's okay.
I was going to say, wow, you must be getting old.
I prefer seasoned, a seasoned veteran maybe.
Seasoned veteran sounds cooler.
I agree. Let's go with that. Happy to be here. Happy to be able to spend a few minutes talking about the recent Fed rate cut and really kind of the impact that it could have on individual finances more than anything. I think that we're probably going to have some more quick, and I think in the next 12 to 18 months, maybe we end up back where we were pre-2008, which isn't a bad thing. I think that overall, as we kind of go through kind of some discussion points, I think people really kind of appreciate what's kind of coming.
So when we talk about the Fed cutting rates, talk about give everybody kind of a big picture. What's the Fed?
Yeah, so the Fed is really the governing body when it comes to interest rates. And the goal of the Fed is to not let the economy just kind of run rampant with inflation, and which we did see during COVID. There was just so much money that was out in society and out in the economy that prices, you think about the simple supply and demand. As demand goes up, supply at that time was very hard. We had supply chain issues. I think during that time, maybe did we not have a ship stuck sideways in the Suez Canal?
Yeah.
Was that during COVID?
I think it may have been. So right towards the end.
Right towards the end. Yeah. I mean, we had all these things that, and trust me, don't get me wrong, a ship stuck sideways in the Suez Canal isn't going to just completely ruin the economy. That doesn't happen. But it's news of it, right? It's like, oh, well, this happened. So what if this happened? And what if, the dominoes start falling? So the goal of the Fed is we want an amount of inflation to go up on average 2.5%, 3% a year, because at that point, people's money can then grow enough to keep pace with, so you can afford the same goods and services in 1 year, 2 years, 5 years, 10 years that you can today. And the problem is things were just getting so expensive that the Fed had to step in, because the money that everybody makes, that didn't change a lot. I mean, it went up, but it didn't go up enough to keep up with that inflation curve. So, the Fed steps in and it says, you know what, we're going to raise interest rates. We're going to slow the economy down a little bit, pull the reins back. So in 5 years, 10 years from now, we're not looking at things costing double, triple than what they were before. Now, some of those things are going to, some things, those price hikes are here to stay, because those companies know they can get it. People are paying it, and they're not going to lower it. Again, back to supply and demand. So with slowing down inflation and allowing our money to last longer and being able to afford those goods and services, the Fed's going to raise those rates, slow it down. Then when it gets to a certain point, they're going to say, all right, well, inflation has normalized. We're basically at very little to no inflation right now, year over year. And so now they can begin to lower that, because when you raise interest rates, it directly affects the consumer. One big way that it does is through borrowing. You have way less borrowing power. So if you're going to pay 6% on a mortgage versus 3% on a mortgage, that's going to really affect the amount of house that you can buy. Same with a car. All these things that we as normal everyday people depend on, we've got to purchase, and we got to be able to afford them. And so that link directly affects what you and I are able to afford on a daily basis.
So let's talk about a couple things real quick that you've touched on, but I think are super
I touched on a lot. Sorry, that was a lot of words. So we should probably go back. I just kind of kept rolling.
So when you talk about interest rates during COVID and coming out of COVID, we had this huge labor force reduction during COVID. A lot of people were told to stay home, didn't go to work, but they had extra money because the government was giving everybody extra money. So you're sitting at home, and all of a sudden Amazon packages are just showing up every day.
You let them sit out for a day, though, because we don't want to have COVID come in the house.
That's
so let it sit out for a day, and then we'll bring it in.
So as we come out of that and people return to work, there's still some of that money available. It's in savings, it's in money markets and all these things. So when people return to work, then all of a sudden the spending really takes off.
You bet.
But we still have a supply chain that hasn't recovered from the COVID problem, right? That drives prices up, like
Correct.
you talked about. And with interest rates really low, people are like, well, I'll just borrow money to do that.
Money's cheap.
When
I can make more money in a CD, in a savings account, than what it costs me to borrow against my home equity line.
Right.
There's a problem with that, though.
Yeah, there's all, that's kind of what I'm leading to here.
A lot of people have realized that problem. You know, I get calls every day about home equity line rates. Those people that leaned on those home equity lines to then go spend money and do home improvements and build a deck because they want to stay home now and move and take vacations. Well, now that's all of a sudden at 8.5%. And it's been that way for a minute. That puts a lot of pressure, especially on retirees.
Yeah.
Because those people that had a house that was paid off, and all of a sudden they decided, hey, I want to stay in this house, so I'm going to put a fence up, make my yard nice, I want to stay outside. Now they're paying 8.5%, 9%, and they don't know why. And it's like, you know what? Yes, this happened overnight, but it had to.
Yeah.
Had to.
Yeah. So one of the things, you know, I have a lot of conversations with people about interest rates. Hey, should I buy a house? Should I refinance? And when you look, people are like, well, my current rate is 3.25.
Right.
The new rate is 6.5. You know, you're going to double that interest rate. And you touched on it briefly that the Fed raises those rates to control demand, right? We're going to say that's going to go up because if you've got the entire United States building new houses, lumber becomes lumber prices.
Was a big issue. Lumber was a massive issue.
Massive issue.
You bet.
It drives up those prices to bring demand down so those companies can get caught up, can get in front of it and create more supply than demand, bring the price back down. It's cyclical.
You bet.
It's going to happen like this all the time.
You bet.
People scream that, hey, we can't do this at a 7% interest rate. Well, if you look at that number historically, it's pretty low.
You bet.
I mean, borrowing rates, now we're talking 40 years ago, they were double digits.
You bet.
We just have a recency bias of they were under 3.
You bet. And it went up quick.
And it did go up quick, but so did demand.
So did demand.
So that's how you counteract that. And we talk about this all the time. Market cycles, 6 to 8 years. We know there's going to be downs. We know there's going to be ups. But that's how the market rights itself. That's how it takes care of overpricing. That's how it takes care of all of those factors is that cycle. The longer you're in it, the more cycles you go through, you understand it.
You got it.
We haven't had a cycle like this in a long time to where interest rates were going up this quick. So a lot of people felt the pain of that. And it's not something they had felt. And I'd never felt it in my lifetime.
Right. Sure.
Because the last time it happened, I was a teenager.
Sure.
So
and I was just bored.
Yeah.
Just a reminder.
Just a reminder. So I hadn't lived through it before. So you feel that pain and you read about it and you look at historical facts and all these things and you're like, oh, yeah, this is what it does. We had a little bit of a pop 20 years ago. Nothing like we saw this year to where they more than doubled on the interest rates. But I think a lot of people don't understand you have to do that in order to contain the demand.
You bet.
Everybody says, there's these housing shortages all over the United States. But if you think of the size and scope of that demand, if you have, just say the lower 48 states all building at these rates, the resources that they're consuming, even through labor, right, drives up labor costs because now all of a sudden you need construction crews everywhere.
Yeah.
So those guys can easily say, hey, I need a $5 an hour raise.
Right.
So that cost goes up.
All affects the bottom line.
Yeah, all of it does. And it's a huge cycle, and we have to go through it to right those prices. We can't, as an economy, stay at 2.5% interest rates forever because the resources can't stay up with it.
Sure.
And then that drives the price up. And then people can't afford it. And that's kind of the natural portion of it. But what you have is a larger separation of the haves and have-nots.
Correct.
Right? So you got to control that as well, too, because there's a portion of the base, the consumers, that get priced out by inflation.
Correct. And they're priced out and never to be priced in again.
That's what we're going through now.
Yeah.
You see those prices in the grocery store of stuff, and you're like,
when did a gallon of milk cost? When did that go up to this? When are eggs this? Like just their basic consumables. Like, we're not talking about going to the grocery store and feasting, like going
right.
and filling a cart with steak and
Have
hamburgers.
you filled a cart at the grocery store?
No, you can't. You physically can't, because things cost so much that if you fill the cart, your card's going to get declined.
It's pretty crazy.
It is.
But, I think my point is that's cyclical. And
It
we
is.
have to, but those cycles are necessary
You bet.
for the market to right itself.
You bet. And it's a good kind of transition into talking about kind of where we are in the cycle, right? I mean, you mentioned the cycle, and I hear it from clients all the time, like, well, the economy stinks. And I'm like, in what regard? Like, how do you feel? What are your, do you hear this and it's just, I want to believe it? Or is it always like that? We're just naturally negative-minded people? The economy, I think, my opinion has been extremely resilient, especially this year. We're meeting with clients that pretty good double-digit returns.
Yeah.
They're not mad.
No.
That's great. But I think we have to be careful. And because right now we're kind of on the bottom of the cycle, and we've got to get back up there. And sure, that's a 12, 18, 24-month window, 36, 2 to 3 year window maybe. How do we think about the economy being in a bad spot when the market's at all-time highs?
Yeah.
That's a tough thing to think about, right? And
Unemployment is still historically pretty low.
pretty low, not where the Fed would like it.
Yeah.
The Fed would like unemployment higher.
Yep.
They've been there are two main things that go into recession. A lot of people don't realize this. One being negative GDP, negative growth quarter over quarter, 2 consecutive quarters. The other has to do with jobs. And that's why, even though a couple years ago we had 2 negative quarters of GDP back to back, we technically were never in a recession, because the job market was still so strong. So when you have a strong job market still, you have equities at all-time highs, but you have a market that's on the bottom side of this swing back up of the cycle. I think we have to be careful with next year, and I think that a lot of people are talking about next year being a recovery year. But we got to be careful with that, because what I feel like is that, and I'd like your opinion on this too, my opinion is a lot of next year's growth is priced in now. I don't know what that number is, but the market always trades ahead. That's why you can't ever really just time it and beat it constantly, consistently. So, I think we need to be really careful. I think that we could, even though next year is considered a recovery year from an economic standpoint, that from a market standpoint, a good chunk of that's priced in. And I would be extremely happy with the 90 plus year average of 7.5% roughly at this point. Get these gains in there. We got this recovery. We've already experienced it in our accounts. Now we'll just enjoy it from an economic standpoint.
Yeah.
That's my opinion. I don't know what your thoughts are.
No, I 100% agree with you that looking forward, right, the market, we say, kind of bakes in stuff from the next 6 to 18 months.
You bet.
Because you hear all this talk now of, hey, our forecast looks good. So we're pricing that in now, because in 6 months, the forecast may not be so great.
Right.
The economy's still going good, but all of a sudden the stock market could start coming down.
Sure.
Right? The stock market's going to be a leading indicator on that a lot of times.
Exactly.
So I think there is a lot of truth to what you're saying, and, setting the expectation with clients that, hey, look, we're looking for 6.5%. We build retirement plans on 6.5%, average annual return 6.5%, we think is something that we can get, right?
Conservative.
Something we want.
We want to be conservative.
4% retirement withdrawal, 2.5% inflation, 6.5% is what we're looking at banging that out every year, right?
Mm-hmm. So if you do better, more money is not a problem.
Right.
Less money is a problem.
Right.
If you don't have enough, that's a problem.
And then when you compound on top of that, it's totally what we're hoping to do and what we plan for. But setting the expectation of 6.5%, I think, is a huge deal.
You bet.
Because like you talked about, people are high teens, low 20s on returns.
You bet.
And you're like,
don't get used to it.
Don't get used to it.
That's the first thing I say.
Those don't happen a lot.
No, you have to manage expectations, and I think that's a very key part to what we try to do day in and day out. People ask me all the time, so what do you do? What do you do? And sometimes it's tough to answer, but I think I've thought about it a lot, and managing expectations is almost number one. Aside from the money management part, the how do we allocate?
Yep.
That's been around for years. Right? We just try to fine tune it and make it more efficient.
All right. So when the Fed cuts rates, how should consumers react to that? Like, what's your best moves when interest rates start moving down?
Great question. A couple things. Depending on kind of the outlook of what we're dealing with and how long we could expect rate cuts, there are a couple things that consumers can do. One is check your mortgage rates. If you're in a fixed mortgage 15, even if you're in a 7-1 ARM, like a variable after 7 years, you really kind of want to keep tabs on those mortgage rates and see when you might be able to refinance. And just from a looking out standpoint, where that lands, we don't know. We have best guesses. But I think that's one main area where people can really kind of save money in the long run is being able to go ahead and lock in at a 15 or 30-year fixed mortgage at a lower rate. So if you purchased a home in the last couple of years, probably a good idea to watch that. Secondly, with that, home equity line rates, I say this all the time, and it's just what it is, but banks are not in the business of giving free money out.
Right.
That's not how they work. And so one thing is to be proactive with a lot of those variable home equity line rates. Talk to your lender. It's worth a phone call. Hey, have these home equity line rates come back down since this first cut? And if they say no, okay. But when there's another one, call back. You have to be proactive with lending and banking. It's just what it is.
Yeah, they're not going to call you.
They're definitely not going to call you.
No. You need to be proactive. You need to be involved in your personal finances and say, hey, this is important. It is costing me money. Is there a way I can reduce
that
the
you
amount
really
it's costing me?
Ultimately don't have to spend once you get a refi. I mean, there's an option there.
Sure.
So, and that option may not be today. It may be 6 months from now, it might be a year from now, it might be 18 months from now. But the idea is that there is going to be an opportunity. Yeah. It's going to happen.
Yeah, because we're kind of at the first step of this. Hey, let's have this conversation. Let's
be thinking about it.
Let's do some research and say, hey, at what point does it make sense for me to do this? If they make 2 more cuts and all of a sudden we're looking at they've cut interest rates by a full %, okay, maybe we need to have that serious conversation with our mortgage broker, start looking for new credit cards that maybe, hey, my credit card isn't lowering its rate, but there are rates out here lower than mine.
You bet.
Balance transfer,
balance, all those things.
Having those things, those thoughts and those conversations.
Yeah, and if anyone listening to this has questions about that, just give us a call, shoot us an email. We have Brett's gonna talk about how to get in touch with us at the end. So just a simple, there's no dumb question. Because ultimately, this is something that can affect the rest of your life, depending on where you're at in life. So, it makes a big impact. In that regard.
And I mean, the mortgage is just a piece of it. You put the mortgage there with some credit cards, maybe an auto loan refinance. Next thing you know, you're like, oh, across these things, it's 3.5% I just saved.
Yeah, and now it's all this, and you equate that to real dollars, and you equate that to $500 or $600 a month.
Yep.
Now you can fill the grocery cart.
Yep, that we talked about earlier, for sure.
It's just trying to figure out how you can take advantage of those opportunities that are in front of you versus just kind of letting them go. Because like we talked about, they're not going to call you.
Yeah, for sure.
You have to be proactive and you have to take control of your personal finances because no one else is going to do it for you.
Right, for sure. I was just getting ready to say that exact same phrase. Yeah. This is it's your responsibility.
You bet.
You're responsible for it. Let's be a good steward.
It's called adulting.
We don't like to do it.
But it's necessary.
It's very necessary. Let's talk about, there are pros and cons to reduced interest rates. Yeah. Pros, lower financing options. Cons, lower savings rates.
The negatives are going to be more for the Dave Ramsey people.
Yeah.
The Dave Ramsey followers of pay cash and do this. Now, that's obviously worked in the last couple of years, but overall, you got to kind of be careful with that. And I'm not trying to say don't listen to Dave Ramsey, but what I'm saying is that Dave Ramsey doesn't know your personal situation. Yep. He's trying to help a broad group of people, and that's great. But at the same time, those savers, those people that pay cash and then save and save and save and save, what they're used to getting in money market rates right now at almost 5%, 4.5%, CD rates, where they're like, oh man, this is great, let's lock this in. The problem is those are going to continue to go down.
Yep.
And ultimately, I talked briefly about pre-2008 numbers earlier. And when I first started in 2004, money market rates were at 4% flat. I can deal with that. Money market rates at 4% are not a bad thing because we're outpacing what?
Inflation.
You got it. We're at least keeping up with it. So I'm okay with that. So let's get back to pre-08. We have 4% money market rates. We have, high threes in the CD market. That's a fine place for your fixed income bucket. Blend those things in. Don't make it all of it. But at the same time, when those saving rates are dropping, historically, equities in the stock market are doing what?
Going up.
You got it. So we have to be very mindful of allocations and going forward. I mean, we all know that all of us have certain degrees of risk tolerance that we need to stay within. But at the same time, it's very important to really kind of understand what's probably going to happen since we have 90 plus years of market history. What's probably going to happen over the next 3 years. And that's probably going to be the continuation of the bull market based on history. Obviously not a guarantee. But if we can build in and get to a 4% fixed income rate and have that bucket in there, taking over kind of the fixed income side, mix in some bonds, bond pricing is going to do nothing but go up when rates come down.
Yeah.
So as rates come down, you're going to be paying more for bonds anyway.
Right, because we're kind of in this changing environment of bonds have not done well the last couple of years.
They haven't. And now it's like, all in, let's go.
Yeah.
How much money can we get into bonds?
So we had a bunch of cash on the sidelines.
You bet.
Right, because CDs were doing so bad.
Right.
That money markets were paying 5%.
And liquid.
So allocation change.
You bet.
Now we're kind of at that point. It's like, hey, we need bonds are going to start to pick. If everything plays out the way it historically has, we're going to see that, and we need to get money back into that. Yeah. But like you said, it's everybody's risk tolerance.
Yeah.
Every person's situation is different.
You bet.
Because your neighbor does it doesn't mean it's good for you.
You got it.
So I agree 100% with what you're saying. Even back to the Dave Ramsey stuff. That stuff is phenomenal to get started. But once you get to a point, it may not apply to you anymore.
May not apply.
So
it's a good problem.
Yeah, it's a good problem. Hey, you know what? I've gone through all these baby steps.
Now I'm here.
Yeah.
What do I do now?
What do I do now?
And like you said, from a risk standpoint, there's always going to be a place for the bond market and the fixed income side because of risk. And we're very mindful of that. And at the same time, we want to make sure that we're educating our clients and educating people on, hey, this is probably what's going to happen. We go back to managing expectations. That's what we want to do is help to manage those expectations. For sure,
100%. All right, so we talked about this earlier, that lower interest rates encourage consumer spending, helps the economy take back off because now all of a sudden lower interest rates. Companies are spending money, people are spending money. There's all these. So we're in that portion of the cycle to where now we're actually going to start building inflationary pressure
again
because we're going to start increasing demand.
And the Fed's there to make sure we don't go nuts with it.
Yeah.
That's what their job is.
That's where you get the terms soft landing. You get all these terms and cliches that they use when they talk about the Fed interest rates and how we avoid a recession. And, how do we maintain that when it comes back up, because quarter, 25 bips, 50 bips can make a huge difference in a person's finances, personal finances. But the economic effect of companies doing that with millions of dollars, can have a huge effect on that.
You bet. And there is one thing that we should really say, that I want to say is that regardless of what year it is, regardless of what the economy looks like, there's always going to be pressures, worldwide economic pressures, geopolitical pressures, world economic indicators that the market doesn't like, that the Fed doesn't like. That's always going to exist. Yeah. And this is not the last time you will see the Fed raise rates. If you can sit here and guarantee one thing, is that something is going to come along in the future that's going to cause this cycle again.
Yeah.
And so the more that we understand about this cycle, and the more these cycles that we live through, the more we understand that 2-year correction or that 2-year down market or 1-year down market or whatever it is, we understand it a little better. And we understand that in the long run scheme of things, it is just a blip. Yeah. Because when you get 50 years of market history and you look at the downs, you can find instances almost every time of one of those things that's happened that I just mentioned will happen again. Yeah. And so the more that we go through and the more we understand, the more that we can be comfortable with it as a natural occurrence, because that's what it is. Adam Smith talked about the economy being an invisible hand, right? It was Adam Smith. I hope that was Adam Smith. Fact check that. That's from college economics. But it really is true. And the economy is going to be the economy no matter who the president is.
Yep.
No matter what Japan does with their interest rates overnight on a Sunday to cause a 1,000-point down market day on the Dow the next day. I think it was 700, but who's counting? Those things happen, and some of those things happen, and the normal consumer that doesn't do this for a living, they don't hear about those things.
Yeah.
And that stuff happens all the time. And so we've got to condition our minds to be okay with that. And we got to condition our minds to think in terms of percentages and not dollars. And if we do that, then we can be comfortable with those moves. And we can expect those the next time they happen. Because we've been through it.
Yeah, right. But we have, these financial TV channels that just sat there.
People that get paid to talk about it.
Red all over the screen.
I know.
The
Every
sky
day.
is falling. And
every day. Like I literally, there was about 10 years ago, I got a phone call from someone who had just retired. And he and his wife retired at the same time. Probably not the best idea, but okay. They retire at the same time, and every morning they literally sit in front of the TV and watch the market until noon, 1 o'clock, sometimes even longer. And then you end up in times where the market's going down, and they call me and like, what do we do? You know what my answer was? Go enjoy retirement.
Yeah.
Don't, like you pay me to worry about it. I'll worry about it. There's no reason for you to. I have you in a situation, in a setup that is perfect for your situation right now. And if we need to change it, we'll change it. And you know what? That's just the truth. You work so many years. Why work all these years to worry about it? Work all these years to enjoy it.
For sure.
Got a question? Call.
Yeah.
Don't
sit there and watch it all day.
Don't sit there and watch it all day.
Like you talked about it earlier. If you watch every up and
every
down,
blip,
you're going to constantly be worried about it.
We're negative-minded people.
But because you're looking at a very small window, drag that out a little bit, and you're gonna see it's like this. Mm-hmm. But there's gonna be a lot of the ups and downs, a lot of the movement. But that's what markets do. They react to news.
Otherwise, it would be a bank.
Yeah, they react to news. A bad quarterly report. Hey, oil embargoes, oil taxes. Production. All of that makes the price of oil all over the place.
I would guess that if we looked at a chart of the last 50 years of oil prices and equity prices, that you're going to see probably a lot more volatility in the oil prices.
Oh, for sure.
I mean, that's an educated guess. And I think that, as the broader market, when you take a look at the broader markets and you can expect the 6.5 that we talked about earlier, based on some allocations, it's just one of those situations where we want to be conservative about it. We want you to be comfortable with it as a client because we know that we are putting you in a better spot than if all this money was in the bank. We know that.
Yep.
Legally, I can't sit here and guarantee you that. But I can show a 90-plus year history that supports what I'm saying. And so from that standpoint, we want to manage those expectations, manage emotions, and really educate people so they kind of protect them against themselves.
For sure.
I have to do that with me, my own self sometimes, and I do this for a living.
Yeah.
It's natural, it's normal.
Yep.
And it's just what it is. For the people who can embrace that versus be very just put off by it or distanced from it, or I don't want to deal with that, those people are the people that are going to be okay, ultimately. That's with the education, expectations. That's what we're trying to do.
What would you like to say in closing?
I think it's been a great conversation. Yeah. It's been good.
We talked about, we get all wound up.
We get wound up and just keep going, and it's great. There's a lot of words in this, so but it's good. It's good. I think that at the end of the day, be a proactive person. This is the easiest thing to put on the back burner. The easiest. It doesn't involve your health.
Yep.
It's not an immediate thing that has to happen. You're like, I'll worry about that later. You got to be proactive because you can never, ever, ever get time back. All these other things, you can save more money, you can pay more on debt, you can work harder, you can work more hours, you can work less hours. All those are variables. Time is not a variable.
Yep.
Time is fixed. It will forever be fixed. You can't create more of it. When it's gone, it's gone. Take advantage of the time you have, be proactive, and just enjoy life.
Words of wisdom.
Sometimes.
For sure.
Comes up sometimes.
All right, again, everybody, Brett Rice, Jason Pike, coreVISION Financial Group. Thanks for joining us today. Our contact information will be at the end of the video. Like Jason said earlier, if you have questions about this, do not hesitate to shoot us an email, call into the office, ask to speak to one of us. It's what we're here for. We'll be glad to talk you through it. We'll be glad to help educate you if you have questions about anything. But again, go to our YouTube page, subscribe, be notified when we post new videos. Thanks for joining us, Jason. I really appreciated it.
Thanks for the time, Brett.
Thanks,
Appreciate
everybody.
you.